One of the major drivers of the crazy housing market that we've seen over the last couple of years has been ultra low inventory. Simply put, there's just not enough homes on the market for all the demand, and that drives up prices. Of course, this low inventory is combined with other market forces like low interest rates and high demand, and together they have created this frenzy for housing price appreciation that we've seen, and really I had never expected to see in my lifetime. And although rates are starting to go up, which will change the nature of the housing market, the impact of the era we are leaving behind, this era of ultra low mortgage rates, may be impacting the housing market for years or even decades to come due to what is known as the lock-in effect. What's going on, everyone? This is Dave Meyer, VP of Data and Analytics at BiggerPockets, and I'm super excited today to talk to you about this new phenomenon that is impacting the housing market and could impact the market for years to come. Before we jump into our topic, you should check out On the Market. It is my new podcast and YouTube channel that goes every week into explicit detail. We do original research about the data, the news, and the trends that are impacting investors all across the country. If you like this kind of data, which I think you do because you're watching this video right now, make sure to check that out. We'd really appreciate if you subscribe to our YouTube channel. As I've said before on these videos, and I will say again, in order for prices to moderate, for the housing market to slow, or for the market to crash, whatever you personally think is going to happen, and for the market to stop going up in the way that it has been for years, we need inventory, which is a good measure of the balance between supply and demand. We need it to go up. It is super low and it needs to go up. That is the only way that prices are going to moderate. And inventory is a little bit confusing what it exactly means. So let me just take a minute and explain what that metric is. Inventory is defined as the total number of homes on the market at the end of a given month. So if we were looking at March 2022 inventory, the number of homes that were on the MLS, like Zillow or Redfin or whatever, at the end of the last day of March 2022, that is what inventory is as we're talking about. And the reason I like inventory so much as a metric to measure the housing market is because it combines both supply and demand, right? Because it doesn't just say like how many homes were listed for sale total that month. That's something called new listings, which we'll get into a second. And it doesn't measure, just demand, like how many homes are sold. It measures how many homes are staying on the market, right? So it factors in those new listings and it factors in how quickly and how many people want to buy it to give you a good measurement of the health of the housing market. So let's just take a look quickly at where we are with inventory. If you look at this chart from Redfin, you can see that inventory is extremely low. I went over this in my video last week, so I'll just touch on this briefly, but we used to have over 2 million homes on the sale inventory before, back in 2013, 2014, over the busy summer months. Right now, as it sits, we are seeing only 600,000 homes of inventory right now. So that's less than a third of where we were in 2013, 2014, and about a third of where we were pre-pandemic in 2018, 2019. So hopefully you can see that inventory is extremely low. And as I've said before, in order for the market to change, we really need higher inventory. And yes, it's not 100%, but it is extremely likely that for the market dynamics to shift, inventory has to go up. So let's take another look at this Redfin chart and see what new listings, again, this is the total number of houses that are put on the market in any given month, look like on a non-seasonally adjusted basis. So this is just the raw data. And as you can see, it's a little bit confusing, right? It spikes up every year and then it dips down. And that is known as seasonality. When you see the same pattern in the data year over year, like we do in this chart, that is known as monthly seasonality, which means, in every March, we see the number of new listings start to spike. Then it peaks around July or August, and then it dips all the way until February, where then it starts spiking again in March. That's known as seasonality. So if this chart is a little confusing to you, that makes sense, and why a lot of housing analysts, myself included, choose to look at housing market data on a seasonally adjusted basis. So if you look at this chart instead, it basically accounts for all that crazy fluctuation based on the time of year and just shows you, like, compared to last year, compared to where we would expect it to be at this time of year, where is the data? And as we said, the last month of data that I have data for that I'm showing you here is March, and things always go up in March. So it's not helpful to say, like, new listings went up in March over February, because that happens every single year. It's not insightful. What we want to look at is where are things in March compared to where we would expect them in March. And on this seasonally adjusted chart that you can see here from Redfin, you can see that new listings have been down for 3 straight months. Hopefully this makes sense, but if you don't, just Google what seasonally adjusted means. It's really important when you're looking at housing market data. Just take my word for it. So as you can see, seasonally adjusted listings are down. Many people believe that inventory is on the verge of recovering. Personally, I hope they're right, because increased inventory would lead to a more balanced, healthy housing market. You know, if that happens, great, but where is that going to come from? New construction could add to new inventory, and I think it will, actually, more than it is currently. We've seen the number of housing starts and housing permits go up for months, but number of completions, which is like how many new construction, new builds actually hit the market, hasn't gone up because supply chain and labor issues have slowed down the building process. I do think that's going to catch up, so we will see an increase in new listings from construction, is my personal belief. Many people also see that we're going to have an increase in inventory from foreclosures, but that is not going to happen. You can watch my other interviews and other videos about that, but to put it shortly, mortgage delinquencies have dropped for 7 straight quarters. The forbearance program worked. People are just not defaulting, so I'm not going to get super into that because it's just not going to happen. Lastly, and the most important, is homeowners. That's where new listings come from, because that is the majority of people who start selling their houses. So will people start to sell their houses in this changing environment? One train of thought says yes, people will want to sell since prices are so high. This is a good time to sell. But there's another train of thought, and this is where the lock-in effect comes in. And this is what we're here to talk about. So recent data from Redfin shows that 51% of homeowners with a mortgage have a rate below 4%. With rates as of now, as of this recording, they're at about 5.3% on average for a 30-year fixed rate owner-occupied mortgage. At 5.3%, people, if they were to sell, if you had a mortgage below 4%, you would be selling at market highs. Yeah, that's great. But you would also be entering a competitive market with higher interest rates. And that's not such an appealing market to sell into. So to put this into perspective, consider this. Consider a $425,000 house. If you had a 3.5% mortgage, which is honestly probably about average, it's crazy to say, it's probably about average over the last couple of years, because it actually got as low as 2.7% on average, but let's just say it's 3.5% mortgage. You would be paying around $1,910 a month. Now, if you bought a similar priced house right now at 5.3%, which is what rates are sitting at right now, it would be about $2,360. So that's $450 per month, or $5,400 per year. That is really a considerable amount of money. You have to think about this. Why would a seller do that? If you didn't have to move, why would you sell one house just to have higher monthly payments on the replacement home? Maybe we need to consider someone who wants to downsize. That is a common narrative that a lot of baby boomers, for example, want to downsize. They want to sell their home they raised a family in, get something cheaper so they can invest the money that they make and, just have lower cost of living. If you downsize to a home, say you had a home that was $425,000 and you downsize to something that is, let's say, $350,000, you would be saving a grand total of $0 a month. That's right. You could buy a cheaper, smaller home and still be paying the same amount because interest rates are so much higher. And sure, yeah, you would get some equity out of the deal because you'd make some money and you can invest that, but your monthly cost, would be the same. And that is super important to people who are retiring. Their monthly cash flow is their livelihood. And so if you are making the same, why would you sell to get into a smaller house, go through the hassle of moving, if at the end of the day, you're going to be paying the same amount every month? It is for this reason the term the lock-in effect has been coined. Many Economists and housing market analysts believe the number of new listings could remain down for a few years while interest rates are so high, because people are just going to be really protective of those low interest rates that they have. If new listings and inventory remain low, if this in fact happens, and again, this is just a theory, no one knows if this is going to happen, but if this does in fact happen and inventory remains low as a result, it is going to continue to put upward pressure on the housing market. And listen, this effect is likely to be different in different markets. Real estate is local. We all know that. Utah, Colorado, Washington, D.C. all lead the way with a percentage of homeowners with a mortgage under 4% at 40%. So that is very, very significant in those markets. You see that again, it was Utah, Colorado, Washington, D.C. You can look this all up on Redfin, by the way. On the other hand, you have Oklahoma and Mississippi, which are at like 22, 23%. So probably not as likely to impact those markets as much, but still kind of significant, right? Like if you 20% of homeowners don't want to sell who might otherwise sell because of low interest rates, that is going to impact the housing market for a long time. And of course, some or maybe even all of the upward pressure that this creates could be offset by the downward pressure of rising interest rates. That could lower buyer demand. And so maybe the impact of low inventory won't be as felt, but it's going to be a super important factor in the housing market, likely for many years to come, because let's be honest, interest rates are going up. And although they might go down in a few years, I don't think in the next 6 months, not in the next year, not in the next probably 2 years, interest rates are probably staying up. So I think it's something that you should be following. I can actually even see a scenario where this lock-in effect impacts the market for a very long time. Interest rates during the pandemic were the lowest they have ever been. As I said before, they reached as low as 2.7% at one point. And just for context, before the Great Recession back in 2007, mortgage rates were never below 5%. Never. So in the history of mortgage rates, or at least as far back as I've seen data for, they were never below 5%, and we were at 2.7%. Think about that. It is not clear if rates will ever get back to as cheap as they were during COVID, because it never happened before. Even if it does happen, it could be a long time before it happens again. And so this could have an impact until we see rates as low as they were. Is that going to happen? It could. I'm not sure. Personally, I think rates are going to rise for another year or so, and then we'll see a gradual easing of interest rates. That's just my read of the situation and what the Fed dot plot says right now. Because after all, the Fed has pursued easy money policies for about 15 years or so under 4 different presidential administrations, both parties. So I don't think we're going back to an era of double-digit mortgage rates. But at the same time, I also don't think we're going to see a 3% mortgage again, maybe in our lifetimes. Could it go down to 3.5? Could it go to 4, 4.5? Yeah, I think it will probably come down to where it is right now. But there are going to be people who are locked into rates we may never ever see again in our lifetimes. And I know that sounds dramatic, but it's true. It never existed before. And so we don't know if we'll ever exist again. Of course, no one knows what happens next, but if you're like me and want to get a sense of where the housing market is heading, keep an eye on the lock-in effect. It's going to be very interesting to see if the predictions of lower listings comes true. And to do that, all you got to do is look at new listings and inventory numbers each month. And remember, make sure to look at them on a seasonally adjusted basis. All right, everyone, that is it for me today. Please make sure to check out the On the Market YouTube channel or the On the Market podcast. It is full of data, trends, and information just like this. And if you have any feedback for me or thoughts on topics I should cover in the future on these videos, make sure to hit me up on Instagram, where I am at The Data Deli. Thanks so much for watching. I'll see you all soon.